What if everything you believe about the stock market is only half the truth? What if the record highs you see on financial screens are not a symbol of strength, but a warning signal hidden in plain sight? Because while markets continue to climb to unprecedented levels, something unusual is happening underneath. Salaries are not keeping pace. Purchasing power is quietly eroding. And everyday life feels more expensive, even as financial wealth appears to be expanding on paper. So the real question is not whether the market is rising. The real question is, what is actually driving it? To understand this, you have to step away from the headlines and look at how markets are actually valued. One of the most important tools in finance is the price-to-earnings ratio. It measures how much investors are willing to pay for every single dollar a company earns. In stable economic periods, this ratio stays within a reasonable range because earnings are grounded in reality. They are limited. They are measurable. They reflect actual business activity. But in today's market, something unusual is happening. Investors are paying extremely high multiples, sometimes 40 or 50 times earnings for companies whose future profits are uncertain. This means the market is no longer pricing what exists today. It is pricing what people believe will exist in the future. And belief in financial systems is powerful but unstable. Another key measure is the Buffett indicator, which compares the total value of the stock market to the size of the real economy. In simple terms, it asks whether financial value is aligned with actual economic output. When this ratio moves far above historical norms, it signals a growing disconnect between markets and reality. And historically, every time this disconnect has reached extreme levels, it has eventually corrected. What this reveals is a deeper transformation in modern finance. Markets are no longer purely reflections of economic performance. They are becoming systems driven by capital flows, expectations, and psychological behavior rather than productivity alone. This process is known as financialization, where financial assets grow faster than the real economy itself, creating an environment where perception begins to matter more than production. But if markets are disconnected from reality, then what is holding them up? The answer is liquidity. Liquidity is the flow of money through the financial system, and it is one of the most powerful forces in modern markets. When money is cheap and abundant, asset prices rise. When money becomes expensive or scarce, asset prices fall. This is not theory, it is mechanical behavior of the entire financial system. At the center of this system stands the Federal Reserve. By controlling interest rates, the Federal Reserve controls the cost of borrowing money. When rates are lowered close to zero, borrowing becomes extremely cheap. Companies expand. Investors take more risk. Asset prices begin to rise rapidly, not because value is increasing, but because money is easier to access. And during major crises, central banks go even further by injecting liquidity directly into the financial system through large-scale asset purchases. This creates money digitally and uses it to buy financial instruments like government bonds, pushing capital into the system at massive scale. But this money does not enter evenly. It flows first into financial market stocks, bonds, and real estate before it reaches the real economy. This creates a situation where asset prices rise far faster than wages or production, producing an illusion of wealth growth that is not evenly distributed. And once this mechanism becomes normal, markets begin to depend on it. This is where history becomes important, because this is not the first time markets have entered a phase like this. During the dot-com bubble, investors believed the internet had changed everything. Companies with no profits were valued as future giants. Traditional valuation metrics were ignored because the narrative was too powerful. It felt like a new era had begun. But when expectations finally disconnected too far from reality, the bubble collapsed. Then came the financial crisis of 2008, where the belief that housing prices could never fall led to extreme risk-taking. Complex financial instruments were built on that assumption, hiding the true level of danger inside the system. When reality broke through the illusion, the collapse was fast and global. And in both cases, the pattern was identical. A powerful narrative emerges. Risk is slowly ignored. Valuations stretch beyond logic. And eventually, the system corrects itself violently. Today, a new narrative is dominating markets. Artificial intelligence is real, transformative, and powerful. But the market is not only pricing reality, it is pricing perfection. Companies with uncertain earnings are being valued as if exponential growth is guaranteed. At the same time, passive investing has changed the structure of the market itself. With massive institutions like BlackRock and Vanguard, capital now flows automatically into the largest companies regardless of valuation. The bigger they become, the more money they attract. This creates a feedback loop where size drives more size, and price becomes partially disconnected from fundamentals. Meanwhile, global debt continues to rise. Companies and governments rely heavily on borrowing to sustain growth. As long as money is cheap, the system holds. But when borrowing becomes expensive, that same system becomes fragile. And psychologically, investors are trapped inside a powerful loop of human behavior. Herd mentality makes people follow the crowd. Fear of missing out makes staying in feel safer than exiting. Recency bias makes recent growth feel permanent. Even when risks are visible, emotional pressure often overrides logic. But every system built on confidence eventually reaches a breaking point. It could be rising interest rates. It could be liquidity withdrawal. It could be a shock no one expects. But once confidence begins to break, leverage turns against the system, and declines accelerate rapidly, not slowly, but suddenly. So the real question is not whether markets can go higher. The real question is whether the structure supporting them can survive when belief begins to fade. Because every bubble feels stable, until the exact moment it stops being one. If you're still watching, you're already ahead of most people. But here's the uncomfortable truth. Understanding this changes nothing unless you act on it. Because the system doesn't reward awareness, it rewards positioning. So ask yourself, are you early or already late? Drop your answer below.